The United States has ticked the technical definition now of a technical recession as gross domestic product shows 2 consecutive quarters of negative growth. By contrast, on our side of the border, StatsCan is estimating that Canada's GDP rose by 0.1% in June after a flat performance in May. For more on all of this, we're joined by Philip Petursson. He's the Chief Investment Strategist at IG Wealth Management, and he joins us now. Philip, great to touch base with you once again. You have told us several times on this program you do not think the U.S. economy is headed into a recession. Now, the most recent economic data doesn't mean that it's there. Of course, we're waiting for an official, the umpire's judgment, if you want to call it that, the umpire's call, the National Bureau of Economic Research. What are your thoughts on 2 consecutive quarters of negative economic growth in the U.S.?
So first of all, thanks for having me on. I would say we have to recognize that the risks of recession have moved higher. We have that inverted yield curve on the 10-2 spread, and we're seeing a significant flattening of what would be the confirmation of that on the 10-year 3-month spread that I expect to see invert potentially over the next couple of weeks. And those two would indicate that, yes, the risks of recession have moved up. At the same time, we've seen housing starts roll over. So there are signs that the risks have nudged higher, but I wouldn't take what we've seen in the first half of the year as confirmation that we're heading into a recession. The first quarter GDP number was driven negative by exports. Exports were down 15% annualized in the first quarter, but rebounded up 18% annualized in the second quarter. So what dragged down GDP growth in the United States in Q2 was residential investment. And so this sets the stage for what could be potentially rolling economic weakness through the U.S. economy that I don't think necessarily is a hard and fast rule. As you would say, the umpire isn't necessarily ruling on a recession today, but we do definitely see economic weakness. It could materialize into a recession. But then the question is that a big R or little r? And in my view, it would still be a little r recession that could be short, very mild, and non-consequential, really, to the markets from this point.
Okay, so with that in the background, then, have stock markets adequately priced in a mild U.S. recession?
I would agree they have. I think they have, and I think the market response over the last couple of days is confirmation on that. Remember, the markets hate uncertainty. They hate uncertainty, and what has been the uncertainty through the first half of the year was how far is the Fed going to go? Will the U.S. fall into a recession? Well, now we have a little bit more clarity that the Fed might not go as far as originally thought, and we're seeing that in terms of the U.S. 2-year Treasury yield backing off. And at the same time, Powell reiterated that now they're going to be a little bit more data dependent, so there isn't a hard target in terms of we're taking rates to this point. It's really if the data dictates it, then we're going to continue to raise rates. But the market saw that as less hawkish overall. And then with the view that, okay, fine, we agree that we're seeing some slower economic growth, but it's not across the entirety of the economy as we're seeing through the earnings results. This is the relief, I would say, that the market is looking for, that the confirmation of the potential bad news is actually good news at this point.
Are we seeing that in the rally that the S&P 500 has staged since the middle of June? It's up from 3,600 points and change to 4,100 points.
Yes, and I think that's what we're seeing exactly. We've broken that downward channel on the S&P 500. We've broken above a couple of technical levels. Today's strength, I think, is just helping reinforce that perhaps June was the bottom of the market. I don't know if we'll see a full recovery in the back half of the year, but if we look at the comparisons to 1970, which was another period of very, very shallow recessionary environment, where the first half of the year you saw a bear market on the S&P 500, in the back half of 1970, the market rallied 26.5%. I'm hopeful that we can see something like that, but I do believe that the markets are likely to continue to nudge higher from these levels.
The Canadian economy, as you know, a flat performance in May, another almost flat performance coming in June if StatsCan's flash estimate proves to be correct. Both of those numbers, of course, represent a substantial slowdown from growth earlier in the year. We expected that. The Ottawa Bureau Chief of Bloomberg News, Theo Argyris, says there's no evidence yet of Canada heading into a recession. What's your view?
I would agree that there isn't a lot of evidence, but if you look at the path or the trend, the road that we're headed down, I think the recession risks in Canada can be characterized as higher than what we see in the United States. Reason for that being is housing is such a big component to our economy. The numbers that I looked at showed that the residential investment was 25% of first quarter GDP growth. Well, since then, we've seen rates move up substantially, mortgage rates move up substantially, and housing activity slow down. If you remove that growth stimulus from the overall Canadian economy, what's going to backfill that? And I just don't know. So I do think that we could be prone to greater economic weakness that's really going to be centered around housing in this country. And that would also involve the what I would consider the unsustainable amount of consumer debt that we have as well.
The price of crude oil is important to the Canadian economy. It's also important to the Canadian stock market, given the heavy weighting of energy producers in the TSX Composite Index. You've got a price target on oil for the next 12 months of $85 per barrel. That's down about $12 or so from the current level. Given that, what is your view of earnings on the TSX and the performance of the Canadian stock market versus its peers around the world?
Well, I'm glad you brought that up, because one thing we have to recognize in Canada is that the stock market is not the economy. The stock market is more globally oriented and commodity sensitive. So the $85 average price for crude next year is my conservative low end target. I actually think the range could be 85 to 120, but let's be conservative in our estimates. But $85 oil does lead to earnings expectations for the TSX through the next 12 months of upper single digits. The TSX is also trading at a heavy discount to the U.S. stock market, the S&P 500, and therefore I think we can see a PE multiple expansion here. I think over the course of the next 12 months, we can continue to see the TSX lead some of its global peers in terms of performance.
Philip.